My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to save you some money. My job is not just to entertain, but to explain. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Look, panic is not a strategy, okay? And I make that point over and over again because I don't want you to sell when maybe you should be standing pat or even doing some buying. And today was a day that proves my point. Today where the averages opened down horribly, right? The 9th straight lower opening, only to rebound. And the Dow finished down 349 points. S&P slipped 0.23%. But the Nasdaq actually eked out a gain of 0.10%. Now, this morning, wouldn't it have felt great just to sell everything, to liberate yourself from your losses, to pick up the pieces and go home? And you would have been dead wrong. Dead wrong. Which is why I counsel not to do it. Yet this morning, when faced with a hideous opening, with most indices down almost 5%, it sure looked like we were going to have another Black Monday in our hands, didn't it? That's one where stocks closed down more than 20%. Now, if you thought we were headed for Black Monday, then you would have happily sold down 4% near the open. But I didn't make that call. Why not? Well, let me walk you through it. Full disclosure, there's no certainty we won't face the same situation again, but you and I will do it together. I'm certainly not calling a bottom here, not with this trade team's ill-advised strategies. I mean, I don't even know if they know what they're doing. The endless down openings also can't last. I am saying that it might be too late to sell, though. And you have to start thinking about what you might be worth buying on the next dip, as there will be one. I think there's plenty of bargains there for the sell-off, especially with the oscillator at minus 8.7. Buy! So why didn't we panic this morning? Why did I say stay the course? First, I assessed what kind of sell-off this is. Do we have a problem that's systemic? Meaning there's actual weakness in a rot in our institutions that can't easily be undone. Now, my partner David Faber and I discussed this very point this morning. We agreed that we needed to take the financial crisis scenario off the table because our institutions are strong. And look, we don't believe that the whole economic system is in jeopardy. We don't believe that major banks will fail. We definitely don't like the situation, for heaven's sake, and it's likely we're headed for recession because of the president's ill-advised plans. But we'll pull out of it one way or another. It's not going to be the global financial crisis number 2. And that's important, because if you look at the 15% downturns we've experienced in the last 40 years, the vast majority of times you had to buy, not sell. Normally, when we're down 15%, we actually have seen the worst of it, or the market becomes viable again, unless it's systemic problems like the financial crisis. You have to assume that, yes, indeed, the worst may indeed be behind us. Second, you had to assess the proximate cause of what happened. In 2007, it was the massive leverage in the system affected a huge number of financial institutions. Now, but looking back at most 15% declines, the proximate causes were usually because the Federal Reserve tightened too much or there was a one-off event that eventually resolved itself. Right now, we're clearly looking at a one-off event, the president's decision to enact shockingly high, perhaps, let's just say, even dangerous high tariffs. As long as the tariffs stick, our economy is in real trouble. But it looks like the president doesn't care. He should always care, both short and long term. That's part of his job. That said, the stock market almost always bottoms before the economic indicators like employment, industrial production, GDP growth. Before they start rebounding, the market bottoms. I want to thank Michael Semblis, the unbelievably good strategist, J.P. Morgan, who actually pointed that out in a remarkable talk that was also had some humor to it that he gave today. He noted that the administration lacked rationality in the way it went about this very suboptimal plan. And while it hurt the economy, it's not the beginning of a nuclear spring. Thank heavens. Third, when you just look at things purely historically, you can figure out where we might eventually bottom if things go south from here. At one point, for instance, some companies in the S&P 500 could collectively earn $300 per share. That's what I thought. And it might have traded at 24 times earnings. And that would have taken the S&P to 7,200. Yes, when the market peaked on February 19th, about 1,000 points below 7,200, it seemed perhaps that we could get there. So therefore, we're sticking around for it. Why not? Wall Street was very bullish on Trump's administration's plan for deregulation, for lower taxes, and pro-growth policies. Well, it turns out we weren't paying enough attention to the actual words out of Trump's mouth. Now, this was a moment where the president decided to rearrange the entire world order, albeit in a very slapdash plan that I think could torpedo the economy. He decided we needed extremely high tariffs in order to stop our trading partners from ripping off America. I like that, but not this high. It was not thought through. And he blindsided our friends and our companies, and yes, most importantly, you and me, the shareholders. And we count on this market for our retirement hopes. We bank on the stock market. Could be foolish, but we bank on it. So in the new regime, we have to factor in the unfathomable. Let's be clinical for a moment. Let's go over the numbers. Instead of $300 in earnings per share, we have to give the S&P earnings a $60 haircut. My judgment shared by others in the street. Take it down to 240. Keep that number in mind for a second, 240. Then we have to figure out where the price to earnings ratio might bottom. That's usually at 14.5 times earnings. That's right. That's where they bottom. That would put the S&P 500 at 3,480. That is very far from here. Now, at the ugliest today, we were at 4,835. We closed back above 5,000. That means there could be considerable downside. Yes, it could be down 30%. I'm trying to give you the negatives. If President Trump continues to press these tariffs, we got to keep that on the table. You can't dismiss that 3,480 figure because historically that's where stocks would go in this kind of worldwide trade war. One that, by the way, exceeds the smoot-holy tariffs that preceded the Great Depression. But then we get back to the proximate cause of the decline. It's all man-made. Wall Street's terrified by the tariffs, but we have an arbitrary mercurial president who can declare victory, roll these tariffs back with a stroke of a pen, and then where would we be? We'd have bought nothing. And at some point, the White House won't be able to tolerate a crashing stock market. I know this because if you're at all prominent, you mostly got called about the topic of the logic and the moves and how, if you criticize them, you were wrong. For instance, I talked about, what were the odds of a crash? People didn't like that administration. Now, I think the potential downside will come from a president who refuses to blink. If Trump's not about negotiations or getting better deals, but just about bringing China to its knees worldwide, the market's got a problem. That's how you would see that low-end number. Of course, if he really wanted to go after China, maybe this isn't the best way to do it. Let's say you believe that China's behind the success of the iPhone and you want that to end, as I believe key people in the administration think is the case. The president just placed huge tariffs on Vietnam and India, besides a humongous tariff on China, in order, for example, to force an Apple to build its iPhones here in the U.S., despite Tim Cook's pledge to spend more than $500 billion in the U.S. In other words, the job isn't just to coerce China. It's to coerce U.S. manufacturers to come back here, away from Vietnam. That's why Vietnam had that huge tariff. Those are two agenda items, not just one. That's important. It means there's no possible negotiation because that would encourage companies not to come back here. Sure, the tariffs could raise some revenue or promote domestic manufacturing, but they can't reverse history. And Trump wants to reverse history. It's a tall order, ill-advised one. He wants to do it quickly. Which brings me to the last bullet point. There are many things that have to go right for Trump to successfully reorder the global economy in order to bring back domestic manufacturing and bring China to its knees. First, the high tariffs can't cause a spike in inflation, or else the Fed won't be able to bail us out with rate cuts. Second, he has to negotiate new trade deals very quickly for congressional members who are supposed to control the tariffs wake up. The lower the market goes, the more likely the Republicans in Congress actually throw the president's agenda under the bus. Third, he has to do it without causing a big spike in unemployment. I think if he does get all three, he isn't going to press his bet with these tariffs. Instead, he'll find some reason to declare victory and roll them back, which is why the market didn't collapse today. Bottom line, that's why you can't panic and sell the negativity. It's why you have to stay the course. Maybe even do some buying if the averages go appreciably lower than they did at the opening this morning. That's what we're going to do. That's what I intend to do for the charitable trust. Do some buying. You should be a member of the club. You'll find out. Heaven knows there are plenty of stocks that are down enough to do some buying after today's action. Paul in Texas. Paul.
Yeah, Ski Daddy.
Yeah. Go ahead, Paul.
So the tariffs President Trump imposed on steel should reduce foreign competition and boost demand for domestic producers. Being down 30% in the last month, is the market getting it wrong on ticker CLF, Cleveland Cliffs?
I think the problem Cleveland says, it's two-pronged. One is the balance sheet's not that good, but two, there's got to be demand. I mean, if the auto companies are really cutting back, and I think you're going to have to after initial spurt, that is going to make it so the numbers have to go lower. If the numbers go lower at Cleveland Cliffs, then the stock's going to go to 6.5. That's what happens. Let's go to Trevor in Wisconsin, please. Trevor. Trevor?
Hey, Jim.
Go ahead, Trevor.
How's it going?
Hey, Trevor. All right, how are you?
I'm doing well. I just want to give a quick thanks to your staff. You got a really great group there.
No, we do have a great group, and this is pressing times, and I want to thank them myself. I have not done enough to do that. I've got my head in the sand here trying to get the show done. How can I help?
Of course. Well, obviously, with all the uncertainty that's looming here, I know that's not good for markets and usually stocks, but I did want to ask you if there's a potential path for this to increase some momentum for Bitcoin and therefore maybe Coinbase. What do you think?
Not a bad idea. Bitcoin's down a lot. But why don't you do this? Why don't you buy Bitcoin? Why buy Coinbase? You can just go buy Bitcoin. And I think that's a good idea all the way down here. I prefer that to actually buying the stock of Coinbase. Let's go to Julio in Pennsylvania. Julio.
Hey, booyah, Jim.
Booyah, my friend. What's happening?
Hey, my friend. Hey, we've been following you for 20 years now. My mother-in-law.
Thank you.
Oh, yeah. Betty from Centralia, Pennsylvania, first turned me on to you, and just want to thank you for his advice.
Centralia, is the fire been put out yet in Centralia?
Oh, not yet. Still hot as all.
All right. 100-year fire. I never heard anything like it. How can I help you?
Hey, listen, Target, TGT. I've been looking at the chart, and it seems to be back where it was back in March 2020. Low PE ratio, especially compared to its competitors like Walmart. It looks compelling, like value opportunity right now. Do you think it's a good time to start a position, or is this market seeing something that I'm...
Okay, it's really interesting because it is at 10 times earnings, and it does trade with a 4.75% yield. I think if you're ever going to buy it, you would probably have to buy it right here, frankly. It is cheap historically. How about that? All right, now look, panicking is not a strategy. Sorry to go on so long about this, but I'm glad that we both did this together. Got to stay the course right now and get ready to do some buying. If we do go lower, then today's open. That's the game plan, okay? Retest, maybe go down a little, do some buying. Be a member of the club. You'll get the point. You'll get it before we do. On Mad Money tonight, Levi Strauss & Company's on the move after earnings. I got the CEO to break down the numbers and the state of the consumer, too, and, boy, the tariffs. Then could Max 7 stocks stand strong in this market? I'm going over each one. And yes, I will admit to being puzzled by Apple here. Then I'm taking calls from all across America to hear what you're eyeing in the days ahead. So don't miss my take on your very pressing questions, and stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.